Hello everyone and welcome back to Explain the Charts. Today, September 24th, 2025, we're dissecting the EURUSD pair, a currency cross currently at a pivotal point, driven by a confluence of significant news and intriguing chart patterns. The headlines are dominated by a tale of two economies, a resurgent US dollar and a struggling euro. Recent reports indicate the EURUSD has been losing ground, notably sliding towards the 1.1740 to 1.1760 range from a four-year high of 1.1920 seen just last week. This downturn is largely attributed to robust U.S. economic data, like falling jobless claims and a surging Philadelphia Fed index, signaling American economic resilience. Simultaneously, the Federal Reserve's recent 25 basis point rate cut, bringing the fund's range to 4.00% to 4.25%, was framed by Chair Jerome Powell with a risk management tone, suggesting a less aggressive easing cycle than markets initially hoped. This cautious stance, implying rates stabilizing near 3.5% by 2026, has provided significant tailwinds for the US dollar index, which rose to 97.65. Conversely, the euro is under pressure from increasing disinflation within the eurozone, with the ECB maintaining a neutral stance and Germany's producer price index falling by 2.2% year-over-year in August. French political instability and mass anti-austerity demonstrations are also adding a risk premium to euro-denominated assets, further undermining demand. The market sentiment, reflected in positioning data, shows 60.6% of traders are net short EURUSD, reinforcing a bearish bias for the pair. Now, let's turn our attention to the one-day chart to see how these fundamental drivers have translated into price action. We can clearly identify the last week's four-year high at 1.1920 mentioned in the news, which occurred on September 16, 2025, with a high of 1.19188. From this peak, the price experienced a significant reversal, aligning perfectly with the news of dollar strength and euro weakness. The chart shows a strong bearish move, marked by several red candles, dropping from that 1.19188 high down to a low of 1.1725 on September 22. This rapid decline confirms the four-session losing streak narrative, albeit with a slight recovery post-weekend. Notice the sharp drop between September 17 and 19, where the market shed over 170 pips, indicating strong selling pressure. However, the latest daily candles for September 22 and 23 show a slight bounce, closing at 1.18003 and 1.18151 respectively. This suggests that while the overall sentiment is bearish, buyers are attempting to defend lower price levels. The news identified key support levels at 1.1710 to 1.1700, 1.1660, and 1.1615. Our current price of 1.18151 is testing a critical resistance mentioned in the news at 1.1820. A sustained break above 1.1820 would be necessary to reignite any bullish momentum towards higher resistance levels like 1.1878 and the previous 1.1920 high. But repeated rejections around 1.1840 to 1.1880 are noted as heavy supply overhead. Zooming into the one-hour chart, we can gain a clearer perspective on the immediate price dynamics following the recent dip and rebound. The significant rebound from the 1.1725 low on September 22 is evident here, showing a series of strong green candles pushing the price back towards 1.18. This move indicates a short-term buying interest, possibly traders covering short positions or dip buyers entering the market. However, as we approach the 1.1820 resistance level, the bullish momentum appears to be tapering off. The candles in the past 24 hours show smaller bodies and longer wicks, suggesting indecision and potential resistance from sellers. The TradingNews.com summary mentioned an RSI on the 4-hour chart below 50 and short-term EMAs crossing below longer averages, indicating fatigue. While we're on the 1-hour, this general sentiment likely carries over, implying that despite the bounce, underlying bearish pressure remains. The current consolidation around 1.1815 is a key level to watch for short-term traders. A failure to break above 1.1820 could signal a continuation of the broader bearish trend, pushing the price back towards the immediate support around 1.1770 to 1.1780. Conversely, a strong breakout with increasing volume above 1.1820 could invalidate the immediate bearish outlook and open doors to higher levels. Let's narrow down to the 15-minute chart to analyze the very latest price action and identify potential entry or exit points. Looking at the last 24 hours, the price has been oscillating tightly between approximately 1.1790 and 1.1820. There have been multiple attempts to break above 1.1818 to 1.1820 on September 23rd and into the early hours of September 24th, but each time sellers have stepped in, preventing a sustained breakout. This reaffirms 1.1820 as a significant short-term resistance level, aligning with the news's sell below 1.1820 recommendation. On the downside, repeated bounces from around 1.1790 to 1.1795 suggest a minor intraday support cluster. Volume during these oscillations seems relatively stable, not indicating any strong conviction from either bulls or bears to drive a significant breakout or breakdown immediately. Traders should monitor for a decisive break of either 1.1820 or 1.1790 on higher volume. A move below 1.1790 could quickly lead to a retest of the September 22nd lows around 1.1725, and then further towards the deeper news-sided supports at 1.1710 and 1.1660. Conversely, a convincing push above 1.1820, especially if accompanied by a strong catalyst like unexpected economic data, could see a rapid ascent towards 1.1840 to 1.1880, where significant supply is expected. Given the current consolidation just below 1.1820 and the overriding bearish sentiment from the news, short-term rallies towards this level are likely to be met with selling pressure, making it a potential shorting opportunity for aggressive traders. However, the rebound from 1.1725 shows that strong support exists if the price falls further. To recap, the EURUSD pair is currently caught in a battle between bearish fundamentals and a recent short-term technical rebound. The crucial price levels to watch are the immediate resistance at 1.1820, reinforced by the news and recent chart rejections. Breaking above 1.1820 with strong momentum could lead to 1.1878 and, eventually, the 1.1920 four-year high, but this is less likely given current news and sentiment. Perhaps a 30% chance in the short term, requiring a significant positive Eurozone surprise or a dovish shift from Powell. On the downside, a slip below current levels means we'll reevaluate support at 1.1770 to 1.1780, followed by the significant 1.1710 to 1.1700 zone. A break below 1.1700 would strongly reinforce the bearish outlook, with high likelihood, 60% chance, of testing 1.1660 and possibly 1.1615, especially if U.S. data continues to outperform or Eurozone disinflation worsens. Traders should look for confirmation on higher timeframes and pay close attention to upcoming economic reports, particularly U.S. jobless claims and any further statements from the Fed or ECB. Watch for volume spikes that accompany any breakouts or breakdowns from these key levels, as they will provide conviction signals. Until January 1820 is firmly reclaimed, rallies might be considered selling opportunities, aligning with the current bearish market consensus. Thank you for joining Explain the Charts, and remember to always trade wisely and manage your risk.